Do you flip or do you hold? Flipping 10 houses, keeping 10 houses. Hey everybody, I'm Tarl Yarber with Fixated Real Estate. I've flipped well over 650 houses in my career, and I've always asked the question, do I flip houses or should I be keeping houses? Do you flip or do you keep? Especially in today's market, which strategy is better? Should you be buying rentals and keeping them? Should you be focused on the BRRRR strategy, buy, rehab, rent, refinance, repeat? Or should you be flipping houses, maybe wholesaling houses, something more transaction-based versus long-term investment-based? Which one is right and which one is right in today's market? I'm going to jump into the positives of flipping and the positives of keeping. We're going to figure out which one's going to be better. We're going to go over what I'm doing today as well in today's market and how you can benefit from that right now. All right, so like I said, I flipped a lot of houses in my career. I've learned a lot about real estate by flipping houses. And I've always asked that question, like, should I be keeping more of these things? What about today's market? The market's changed. Rates have gone up. Some areas of the industry is kind of in flux right now. Commercial, multifamily, single family. What do you do in today's market? Should you be focused on keeping these properties or should you be flipping them? Which one is better? Before we jump into specifics in today's market, let's go over some fundamentals and let's ask some legitimate questions about real estate investing to begin with, especially in regards to flipping or keeping. So which one is better? Okay, so let's create a scenario here. Do you flip 10 houses or do you keep 10 houses? What's better for you? What's better in the circumstance? Which one's going to make you more money? Ready, go. Don't know? Maybe you do? Flipping, yeah. Keeping, maybe. But what about maybe possibly thinking about 1 year from now? Which one's better in the next 12 months? Do you make more money flipping 10 houses or keeping 10 houses in 12 months? What about 5 years? What about 10 years? Think about that. Are you still making money on the houses you flipped 10 years from now? Are you still making money on the houses you flipped this year 10 years from now? Probably not. Are you making money on the houses that you kept 10 years from now? Probably, hopefully, if you did it right. So go through that a little bit. Let's create two scenarios here. This first scenario in a situation where you flip 10 houses. So you make 30 grand on each house. Whoop, whoop. That's what you're aiming to do. Let's say you're doing a 15% cash on cash, whatever. It doesn't really matter. Let's say that you flip 10 successfully. The average $30,000 per flip. That's $300,000 over the course of 12 months. Congratulations, before taxes. Now, taxes on flips. I'm not a tax professional. I'm not a CPA, but I definitely have paid enough CPAs and tax professionals and attorneys to be able to act like one a little bit. But from my personal experience, flipping houses, whether it's in one of my entities or not, is still going to be taxed as active income or taxed as ordinary income. So that said, though, if I'm going to be taxed in that situation, then whether it's an S Corp, LLC, it doesn't really matter. I'm going to be somewhere between, 20 to 35+% tax bracket, give or take, maybe 40%, depending on how much you make. It's totally dependent on your business. But let's just say for average purposes, it's 33%. You could pay a little bit less, could pay a little bit more. You net $201,000 after taxes. You also have lots of yelling at contractors over that time period, and you never make money on those houses again. But still, you make 200 to 300 grand. Fantastic, congratulations. But let's say that you bought 10 houses and you kept all 10. Let's say you get $350 per month after all expenses, net NOI, net operating income, $3,500 a month over the course of a year, because 10 houses, 350 times 10 is $3,500. That's going to be $42,000 in positive cash flow. Whoop, whoop. Now, should you be making that on today's interest rates? Maybe. Are those, you're going to be like, where do I get those? That's a good question. That's part of watching lots of videos and talking to acquisition guys. But can you still net that? Absolutely, depending on what market you're in. Now, you're taxed at a passive income bracket. Then that's going to be between 15 and 25%. Not a professional, but it just depends on where you're at. But let's just say that's what it is. You also get tax depreciation because you get to deduct. You get to depreciate the assets on the actual properties themselves. Depreciation is flexible, depending on a couple situations, on your cost basis and all that great stuff. But I threw a random number in there as well. If the houses were worth $200,000. That said, you get 1 year, you get over long-term tax savings, because if you keep the properties over a year, you switch over to long-term capital gains if you ever sell it. Sorry, you get long-term capital gains instead of short-term. Forgive me for messing that up on you guys. So you have a little bit lower taxes, but still, at the end of the day, you're not making that much more than flips. So what about leverage? What about better financing? There are some scenarios that happen there when you keep properties versus flipping them. When you flip a house, last money you ever make on a house, but you can make a lot. Trust me, I know. When you keep a house, you might make smaller dollar amounts in the beginning, but over time, you might make more. So let's average these things out. So let's say that you look at that blue line there is basically you flipping 10 houses every single year. So you flip 10 houses every year. Okay? That means that every year you're making $300,000 per year before taxes. Keep that in mind. So that's a flat line of income, 300,000, so forth, but maybe you're keeping some of it, maybe you're saving some of it, maybe you're not. Speaking from experience and knowing a lot of house flippers out there, if you're making $300,000 a year, I promise you most of those guys are spending $200,000 to $250,000 a year because most people do. Usually the higher income you make per year, the more you end up spending as well. It's kind of one of those things that just seems to happen for some reason. Now, maybe you're highly due diligent and you sit there and you save that money and reinvest it, but most people don't. Spoiler alert, don't be that person. On the red line there, that is you keeping 10 houses every year instead and making $42,000 on each house. So each year it increases. But guess what? This is cash flow. You're not selling any of these houses. So you keep these houses every single year and you'll see that your income goes up. Now it takes about year 7, year 8, give or take, for your passive income to meet what you've been making annually for 7 to 8 years on flipping houses. So it might not seem like it might seem like that's a long time, and it is. It can be, depending on where you're at in your business and your career. But that's passive income. That's money now coming in. That's money that is coming in, and if you do it again every single year after that, you now have $400,000, $500,000, and so forth. And that's not assuming any kind of appreciation. That's not assuming any rent increases or any of that aspect whatsoever. That's also not assuming any kind of repairs or mess ups on the property too. So this is just kind of a good little basis to realize that, hey, yes, flipping houses in the beginning is definitely going to make you a lot more money than keeping them. But over time, your future self thanks you the more houses that you keep. Because you also have things like appreciation. There's houses that I kept in 2015 and 16 that I still own today, 8, 9 years later, that I'm very, very happy that I own. There's also tax benefits. You start actually being able to realize that you can depreciate these things a bit. You can also later do cash out refis and be able to pull out income tax-free as long as the debt pays for it. That's called leveraging. You build wealth, so you build passive income. You get better financing. The more properties you have in your portfolio, the more attractive you are to a bank. By the more attractive you are to a bank, which means that you get better financing, you have better assets, you have better leverage experience, you also have the ability to pledge those things, to be able to sit there and buy more properties and so forth, on and on. There's a lot of flexibility the more properties you keep. However, there's a trick to all this, and there's also a kind of a thing. How do you keep 10 properties a year if you don't have the money to keep 10 properties a year? Sometimes you have to flip houses to have extra income to then keep houses as well, depending on where you are in your financial career. That was more me. I didn't have money early on in my career to be able to sit there and keep 10 houses a year. There was zero chance I could have done that. I didn't have the financial education. I didn't have the financial backing. I didn't have the waiver for my tax returns or any of that kind of stuff to qualify for that many houses to begin with. I also didn't have the capital to be able to do it. So I needed to do things like active income things, like wholesaling properties, sitting out there and going out there and flipping them, partnering with people, JVs and so forth, to build up my reserves, to build up my active income, to be able to start buying and keeping properties. Another thing to think about when it comes to real estate is that, let's say that you mess up on a deal. Time can heal all wounds. Now, sometimes it takes a lot longer for time to heal wounds than we really want to. Think about. So last year in June 2022, the rates really started going up and started spiking quite a bit. If you're in the middle of a real estate project, a fix and flip project, at that time, you got stabbed, basically, potentially, when it comes to actually, flipping this house. Some people got, like me, I lost $150,000 on houses last year due to flips. So sometimes if you keep these houses, time can heal all wounds. In my opinion, that's true for rentals. That's not for flips. A flip is just sitting there. It's a liability the longer it is in our balance sheet. A flip's not making any money. It's just a number on a balance sheet that could be sucking money away from holding costs and so forth from you. Also for property taxes and everything else, it's making no money because it's not being rented. Now, a property that gets rented out, you have a tenant actually out there paying your mortgage, paying your debt, whatever it is. That property you can now sit on a little bit longer, and it's earning income. It's earning it's earning revenue. Hopefully it's paying for itself. Hopefully it's getting some sort of positive net cash flow. Maybe you had to leave a lot of money into the deal because it wasn't a true BRRRR, a true infinite BRRRR where you get all your money out after you fix it up. But maybe you had to leave some money in there, but at least you didn't lose any money. Because in reality, when it comes to these types of properties, there's a few things that kind of happen here. You also get to have, what I'm trying to say is that when you keep a property long term, even though if the property is worth a little bit less than what you might have bought it for at the time, you didn't really realize a gain until you sell the property. As soon as you sell a property like a flip, you're going to realize that loss. Same with realizing the gain if you sell it and you get a positive. Why do I bring that up? It's if you can hold out for a long term on a rental and to get some net cash flow going on in there in that property, well, it's just like paper assets. If you buy a stock at $30 a share and it drops to $25 a share and you haven't sold that stock, did you technically lose that money yet? Not tax-wise and not income-wise and not on paper-wise. Only if you sell it did you actually realize a loss. If that later goes back up to $20 to $30 and you sell it then, you net zero. If it goes up to $35, you start net positive. That's the same thing with real estate. You bought a property for $300,000, put $50,000 into it, cost basis $350,000. Let's say that property is worth $325,000 today. If you don't sell it, you didn't lose your money. If it rents out positive cash flow, you're not losing money. Now later, 10 years later, 5 years later, 15 years later, maybe that property is worth $350,000, $360,000, $370,000 or whatever. You then can sell that property and get your money back. But you also got all your tax depreciation. You also got some net cash flow, all those great things that hopefully would happen in the market. So I believe time heals all wounds in real estate as long as it's a rental, but hopefully it's not forever. If you bought a property in, let's say, 2007, 2008, when the market crashed in the great financial crisis in that time period, then it might have been better to keep the property and wait. A lot of times that property might have been till 2013 to 2015 to 16, 17, 18. Who knows what market you're in before you actually might have recovered from that property. But if it was cash flowing, at least you recovered. If you're like me and you flipped houses and you only bought properties to flip, some of those properties weren't able to be kept and you had to just get rid of them. The $150,000 that I lost last year on the 2 properties were properties that would not have been a good idea to keep because the rents would nowhere near meet the cost basis to be able to meet the debt service that I had on those properties. Basically, I would have negative cash flow big time unless I left a lot of money into the deals. So in those scenarios there, taking the $150,000 net loss actually technically saves me money in the long run because I can write that off. Yes, get a good tax, I get a tax deduction on that as much as I don't want it, right? And at the same time, if I would have had to leave, I would probably had to leave $300,000 to $400,000 into those deals to be able to have them cash flow. Well, in that scenario, that $300,000 or $400,000 would actually make me a lot more money doing something else than putting it back into those deals just so I can net zero cash flow on it and not lose $150,000. I hope that makes sense. So sometimes you have to bite the bullet and write the check to be able to make more money for opportunity cost purposes later. I had to do that on a couple properties. Luckily, we had the reserves to be able to do that. So which one's better? But the reality is it does depend. If you need to make extra income and you need to sit there and create active income and you need to go full time in real estate, it is faster to do it if you do an active income based strategy such as wholesaling or active flips or so forth in some way, because that's going to generate active income and hopefully high active income. Versus holds, if you're making $200, $300 a month on a rental, it could take quite a few rentals before you're actually able to pay for your lifestyle or your standard of living. That could simply just be your mortgage, car payment, groceries, gas, all that stuff. What would I do today though? In today's market with interest rates being as high as they are and looking like they're not going to go down anytime soon, it's becoming more and more challenging to find cash flowing properties. Now, at the same time, it's still pretty simple, in my opinion, to find properties that you can flip. So it's kind of a situation of two things, right? Cash flow properties due to high interest rates are hard to come by, especially if you're only putting 20% down. But maybe you can find a flip that nets you 15+% cash on cash, and those could pretty much be a shoe-in. Maybe you have to wait a little bit longer to be able to on days on market because it takes longer to sell. Maybe they're not huge, juicy, skyrocketing deals like they were a couple of years ago. But you can still bet on sitting there going like, all right, based on the market, based on timing, based on situations, maybe you can find some good flips out there. Maybe you can find some good wholesale deals out there. And you just maybe have to do 2, 3, 4 of them. And maybe you have to put more money down on a property to keep it for passive income purposes. If interest rates are 8, 9% for a long-term debt for you right now, you might have been able to get away with 20, 25% down on that property to cash flow. Maybe today you might have to put 30, 40% down for that same property to cash flow. Now, if you're like me back in the day, I'd be like, that's dumb. I'd rather turn that money and flip it. However, if you put 30, 40% down on a property from your active income that you made flipping houses, you didn't lose that money, right? You just basically put it, in my opinion, a savings account. So you took that money off the table and you just put it into a property, a good stable property with less risk on it because you have less leverage. with the potential that later down the line, if the market shifts or if also the interest rates go down, you have enough leverage, you have less leverage in there that you can later cash out refi at a lower interest rate. So you have more flexibility and options. So maybe you can't go buy 20 houses a year, 10 houses a year as a passive investor anymore, but you still could buy 5, 6, 7 a year if you're actually actively flipping houses and really taking money off the table and putting them back into real estate. I hope that makes sense. Just because you can make 200, 300, 400, $500,000 a year flipping and wholesaling properties doesn't mean you need to spend all that money living a lavish lifestyle, which definitely bites you in the butt over time. Maybe you take half that money and take it off the table and instead put it back onto down payments on secure properties in strong markets, or invest in people like in syndications and funds that you really, really believe in that have a proven track record. Either way, there's always a way to do this. There's always a way to make money in this industry. And in my opinion, it's always better to keep properties than sell them. But, and there's a big but in there, there's always a strategy to be able to sell properties to. So leverage flipping houses as a tool on your tool belt. Flipping has made me very, very good at construction and rehab. It's made me very, very good at estimating ARVs, very good at estimating as-is prices on a property, very good at building teams of people. All these things that people that only invest passively as landlords don't have, because most of those people aren't used to being able to sit there and handle with tons of construction and tons of issues and see an ugly house that's totally messed up and realize that they can just fix it up. But a house flipper sees an ugly house that's messed up, they see money. So I hope that helps. I hope you guys like that. That's what I'm doing. That's what I'm focused on. I am a recovering house flipper. I admit that openly. I'm focused on keeping houses as much as possible these days, but I'm using all those skills that I built flipping houses to do better at it this time around. You can follow me at Tarl Yarber on Instagram. You can comment, like, subscribe to this video, and make sure you guys watch me on the next one coming up soon.